Hello and welcome to the lecture series on monetary economics. In the previous classes, we have seen financial systems, the weaknesses of the same, the structure of Indian financial system, and also greater details into the concept of payment system as well as financial systems. Today, I'll be giving you a very preliminary idea or sense of what a bank particularly means and how the banking structure looks like in India. So let's get started. So at the apex, we have seen that there is something called as the central bank or the Reserve Bank of India. So Reserve Bank of India looks after both the monetary as well as the financial system in India. So that can be further subdivided into banking and non-banking institutions which come under the Reserve Bank of India. Now the banking institutions are classified as scheduled banks and non-scheduled banks. Now I've given you the distinction between a scheduled bank and a non-scheduled bank. The banks which are present in the second schedule of the Reserve Bank of India Act, these banks are called as scheduled banks. Those are not there, they are called as non-scheduled banks. We are going to look into greater details what commercial banks which are present under the scheduled banks and cooperative banks looks like, what is their structure, what are the subclassifications of the same, what is the management level and things like that. So in today's class, first I will give you just a preliminary idea of what a bank means and what are the major or essential functions of a bank per se. Yeah, so this is how the banking sector or banking segment or financial institutions, to be very precise, are categorized or are structured in India. At the apex you have the Reserve Bank of India, then we have the banking and the non-banking institutions. Under the banking we have the scheduled banks and the non-scheduled banks, and the scheduled banks are further classified as commercial banks as well as cooperative banks. In the previous classes, I have given you the sub-classification of commercial banks as well as cooperative banks, but in the subsequent lectures, we are going to look into that into a very greater sense or greater details. Let us now look at a very important statement which I am making here. Commercial banks are the single and most important source of institutional credit in India. So I hope you can recollect in the structure of the financial institutions in India, or financial system to be very precise. I was talking about something called as the formal or institutional structure as well as the informal structure of the same. In the informal segment, we had money lenders, we had merchant bankers, we have traders and all of that. Here I am looking at institutional. Institutional particularly means either it is a banking company or a non-banking company, and in this lecture series I will be looking more into greater details about commercial banks, cooperative banks, development banks and all of that. So we can gauge from this statement that it is the commercial bank which holds or which has the most important part to play when we are talking about institutional credit in India. But before understanding what a commercial bank particularly means, let us look at the definition of a bank, what a bank particularly means. Now, bank is an institution that accepts deposits. There are two essential features of a bank. One is acceptance of deposits per se. Yeah, deposits of money I am talking about, only money I am talking about, deposits of money. So a bank is an institution that accepts deposits of money from the public or from general public, withdrawable by check. How I can withdraw that? If at all I am depositing money, it is withdrawable by check and it is used for lending by the bank. Now here there are two important functions of or two essential features which are describing a financial institution to be called a bank. See, when you look at financial institutions, I hope you can recollect that I classified financial institutions into banking institutions and non-banking institutions. When to call a financial institution, whether a banking institution or non-banking institution, to be a bank? How can I classify it as a bank when that institution accepts deposits of money from general public, withdrawable by check, and the same money is extended by the bank as credit or loan? So if that thing is happening, if these are the two features which are effectively being taken care of by a financial institution per se, then such an institution is called as a bank. So I hope the idea of bank is pretty much clear. Let us now look into greater details. What are these essential functions or features which make a financial institution a bank per se? Any financial institution is called as a bank if and only if it accepts deposits from public which are withdrawable by check, and these deposits are extended as loans or credit to other firms. So I hope the idea of a bank is pretty much clear. Let us now look at what kind of deposits I'm talking about. Now there are three important things which you have to take care of whenever you are going to look at the deposits. So the first important thing is the deposits are of money and not of goods or non-money financial assets. So the deposit has to be in terms of money per se. It has to be in terms of currency. Then only it can be considered as a deposit, which is the bank which is accepting the deposits is in terms of money and not in terms of any other non-money or goods per se. Let us now look into next point, which is essential for something to be called as deposits, which the banks are accepting. Deposits are accepted from public at large. It is accepted from general public. I use that term, general public, and not merely from its shareholders or members. So I hope when I get into greater details with respect to the management, so there are certain shareholders as well that distinguishes a bank from a public owned bank or a private or a foreign entity and things like that. So these deposits are accepted not only from the members or the shareholders of the bank per se, but at large or in general it is taken from the public, the money deposits I am looking at. Furthermore, the deposits are repayable on demand and withdrawable by check. That is, the deposits are demand deposits. So I hope you know this point. In the previous class I have explained you what are demand deposits and what are time deposits. So demand deposits are those deposits which are withdrawable at any particular time. On the contrary, the time deposits are not. The time deposits are, for example, say fixed deposit. Now fixed deposit is for a period of time. You can take that only after a certain period of time. You can withdraw that per se, but you won't get the interest. If at all it is immature, then you cannot get the interest which was promised to you at the initial stage when you were depositing certain fixed deposits with the bank. Furthermore, there's something called as recurring deposits, wherein I am giving certain sum of money every month to the bank, and then the bank compounds the interest and gives it back to me with the principal. So this is how principal particularly means the cumulative deposits which have happened, and plus the extra interest which I am supposed to get on recurring deposits. So these are time deposits. Here I am talking about demand deposit. These are withdrawable at any particular time, and they are withdrawable by check. So these are the three important things you have to make sure you remember when you are talking about a financial institution which is accepting deposits. So deposits are of first money. Second important thing is these are accepted on a very general scale from the public, and they are repayable on demand. They are demand deposits. So I hope these ideas are pretty much clear. Furthermore, the second aspect is extending loans. Now the bank cannot use the money which comes as deposits to the financial institution for, say, its own sake. For example, to construct a new branch or to expand its probably say employees. Banks cannot do that. The only function extending loan means banks have to make sure that they are used for giving credit to others and not used for financing its own business. Banks can finance its own business from the profits which they earn and not from the deposits which they get from general public. So these are the two important features or important essential functions which distinguishes any financial institution, or to be very precise, a bank from any other financial institution. So I hope the idea is pretty much clear. In the next class, we will build our idea of what a commercial bank particularly means. Now we know what a bank is or what a financial institution is when I talk about it in terms of a bank. So the idea is pretty much clear. I hope the idea is pretty much clear with respect to bank. In the next class, I'll be talking about something called as commercial banks, and in the subsequent lectures, we'll get into greater details with respect to cooperative banks, regional rural banks, development banks, and all of that, public sector bank, private sector banks, foreign banks, and all of that. So please stay tuned. Thank you.